Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? This is going to be an interesting one today, and I hope not to take too much of your time, but look, the question comes up all the time, like, Dustin, why would I do any other type of investing besides an index fund? And I get it, it's a good argument, but my question is always, which index fund? Which one are you going to choose? And everybody goes, hey, well, I'm just going to choose the S&P 500. I read a book, Tony Robbins, all these other gurus, they said, just buy the S&P 500. But how did they know that was good for you? What if I can show you that there may be a better one, or maybe you don't need as much risk as the S&P 500? Well, that's what we're going to cover today. We're financial advisors here at Jazz Wealth, and we teach our customers. We teach with data, we teach with current market movements and the data to back that up, so that you learn how the markets move and how we could take the emotion out of it. And look, I want to start sharing some of that with you guys here with the general public, so I'm going to take a shot here. And the first thing I'm going to do is use a study from somebody else. The guy's a PhD. I mean, like, look, we do a lot of geeky stuff for our customers. They can all attest that our market portfolio updates and some of the classes we do for them are pretty crazy, but this guy's a PhD. And I get one of these magazines from my financial magazines and everything. I see the study in there and I'm like, I got to share that, right? I mean, why try to replicate something this guy's already done? Let's take a look at what we're working with here. When you invest, there's a couple things that you want to consider, right? You want to consider the absolute return, and you want to consider the volatility of those returns. If I could just go to the chart here, I'll show you real quick. If I told you that you would average a 9% return, but over the years, this is what it was going to look like. The general volatility of those returns, it'd be some pullbacks, there'd be some good years and some sort of scary times, and that's fine, but ultimately you'd end up with an average of a 9% return, right? It's very, very possible. I'm actually going to show you how it happens. But now what if I said, okay, you're good with that? 9%? Okay, fine. Now what if we looked at it this way? Same 9% return. After a 20-year period, same 9% return, but you're going to see this in terms of your returns. You're still going to end at the same spot, but some years are going to be amazing, and some years you're going to be pulling your hair out. You're going to be so scared. That's what I mean in terms of volatility, or more commonly known as the standard deviation of the returns. I just don't like to say it that way. I like to say speed and volatility. How fast are you going to get that return, and how much in fluctuation do I have to expect? Well, we give all of our clients all of this data, and actually a lot of it's posted right on our website there. But look, many people choose the S&P 500 as an index fund investment, and I want to look a little bit deeper. So let's go. The guy's name is Mr. Craig Israelson. He's a PhD financial planner, and that beats me, right? So I'm not a PhD, so I'm just a geeky guy that likes studying this stuff. Now, what I'm about to show you is a 20-year performance. This is his words, not mine. 20-year performance of a chart that shows the annual returns of 12 key indices from the S&P 500 that we all know, all the way down to some treasury bills. All right? And then at the very end of it, we're showing, what if you just bought all 12 of them? So his argument is, should we try to pick which one's going to be the best, or should we just buy them all 12 of them, okay? Also shown are going to be the 20-year annualized returns, the 20-year volatility of those returns, and the annual returns of $10,000 as a lump sum investment 20 years ago. This is going to also assume a yearly rebalancing, meaning we're going to adjust to keep everything equal each year. And negative annual returns you're going to see are shown in red. The index with the highest return is for each year is going to be highlighted in yellow. That's enough teasing you. Let's take a look. So here we go. Here's the chart that he put together. Don't be scared. Up at the top, we've got the S&P 500 from 1999 all the way down here to 2018. We've got the S&P Mid-Cap 400, same date range, S&P 600 small cap, etc., all the way down to the U.S. 3-month bill. This is known as cash, by the way. I'll cover that in a second. And then over here he said, hey, look, just let's not guess. What if we bought all of them, equally weighted them, and we decided to just buy them all in one shot there? All right? Now, what I want you to notice here is the S&P 500 had the highest return. Remember, the highest return is highlighted in yellow. So if we go S&P 500, the highest return happened in 2015. It is the most popular index, and yet it's only had the highest return once. right? And do you see the return there? It was 1%, right? Everything else, looking over here, was just a negative year. Not really that good, right? The S&P with 1.3% there. What I want you to look at here, real estate and emerging markets, they've had the best annual returns 5 times each, right? You're going to have your emerging markets right in here, your real estate right in here. With there's your 5 yellow to show you the having the best returns twice. Commodities had the best return, they had the best returns 5 times each. Commodities had the best returns twice. And cash had the best return last year. 2018, where was the best place to put your money? Cash. Now, let me stop here for a second. Can I just show you? I'm going to go in here. Cash is not cash. Please don't go hold cash thinking that that's what is best for your money. Cash is the 3-year Treasury bill, right? That is equivalent of cash, and that's where investors put their money to treat it as cash, as a cash rate of return. A great example would be Warren Buffett. A lot of people study Warren Buffett. They like to see where he invests and things like that. Warren Buffett reports, and he'll say himself, I have so much money invested in all these companies, and then I have X percentage in cash. He does not mean in barrels of cash sitting around his quaint little Omaha house. He means that he has them in 3-month treasuries, okay? So I just want to make sure everybody knows that. We're definitely not talking about actual cash here. Okay, moving on. Now, the guy's making the argument here that let's just buy all 12 indices here, not try to pick the winners in here year after year, and just buy all of them. Now, the 12-year annual evenly built portfolio never once has the best return, and he admits that. The goal is not to have the best return. It is to have the best return with the best in terms of volatility of those returns there, okay? So this sort of approach that he's talking about, this is more for the moderate investor. Someone who's not wanting breakneck speed growth, not trying to swing for the fences. They just want a nice, comfortable portfolio for the risk that they want to take there, okay? So it never had the best returns. Over the past 20 years, the 12 index portfolio off to the right that this guy's highlighting here, rebalanced, right, each year, had a better annualized return, down here at the bottom, 6.83%, than the S&P 500. Meaning his approach had better returns. Although it never was the best performer, in the long run it had the best returns, not the best returns, better than the S&P 500. 5.62% for the S&P, 6.83. It beats by 1.21%. I don't care about that, just a tiny difference there. What I care about is one line lower, the volatility of those returns. So remember what I drew for you just a second ago. Ask these questions when you pick investments, right? If I say, oh, hey, you're going to end up with a 5.62% return, right? And you go, oh, all right, after 20 years, that's not horrible. I could live with that. But in order to get that, you're going to have to see this, right? You get what I'm saying here. Or you could go and buy this other thing that's going to have a 6.63% return, and you're going to experience this, meaning it's not going to be that scary. You have smoothed out your volatility overall, and that's huge, right? Think about how many of you going back into December of this last year panicked. You got really nervous. The markets fell. I'm taking the phone calls. I'm talking to people constantly. It's April now, almost May, and people are saying, I got scared. I sold. I ran away. What if you had a portfolio that you knew could be counted on in the long run, but that wouldn't be so volatile? You wouldn't have to suffer so much of the movements in the markets there. So very, very interesting there. Now, also I want to point out, I always mention the S&P 600. If you want the swing for the fences, highest possible return, historically that's the S&P 600 small cap stock. So you want to take a look at that if that's what you're shooting for. It beats the S&P 500. It always does, over the long term, always does, and you're getting the exact same volatility. Right? So all of you that look and go, I'm going to go in with the S&P 500, Dustin, because it's the lowest cost or whatever you come up with. Somebody told me to go buy this thing. You're experiencing the same volatility for less returns than you would if you would have just chosen a different index fund. I am definitely not suggesting that you go take my recommendation here. I'm saying go do your homework to see, oh my gosh, same exact volatility of the fluctuation in returns, but I got better returns over here. So if I'm going to go through the stress of the back and forth, why not go with something that I get a better return for, okay? So something I definitely wanted to point out for you. This guy did a great study here. At the very bottom is how your $10,000 would have grown. I think it was phenomenal for someone to go through that. It's the stuff I love to study. You hear me all the time saying speed and volatility. Speed and volatility. Speed and volatility, right? So that's all you need to know, right? Go ask the questions. If someone has put you into an index fund, ask them why. Why specifically did you choose that one? How did you know that was best for me? What if I want something different? Bug them to death, especially if someone's managing your money. You want to know about the speed and the volatility. Well, I hope that helps you in some way, a little bit different than what we normally talk about, huh? Maybe a little geekier than you're used to seeing. If it helped you, hit the subscribe button. I really, really appreciate it. And we'll be back to at 5 o'clock today, do the closing beat. That's the show that we do about the stock market. We talk about exactly what's happening in the stock market every day so that you know, like, where is everything at? What does all this mean? We teach there as well. So I appreciate you watching. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.